Today, we want to look at capital budgeting, um, which I can simply say is budgeting for your capital, where you're asking yourself a question: is the investment worth it or not? So, we want to look at capital budgeting, which is one of those topics which are very essential in our course, Corporate Finance 1. Now, capital budgeting is a process which involves three basic steps. Number one, you identify potential investments. What do you need to invest in? Review, analyze, and select from the proposal that has been generated. So the main process of capital budgeting is on this stage where we review, analyze, and select from the proposals that have been generated. After we have reviewed, analyzed, after we've actually selected, we then implement and try to make sure that what we accepted is what we are actually getting from the selected projects. We want to get the results that made us accept those projects. We want to make sure that if it's the revenue, we're getting exactly what we're getting. If it's the cost of capital, it's exactly what we'd forecast before. So managers should separate investments and financing decisions. So when we are looking at capital budgeting, basically we are looking at an investment decision. Should we invest or should we not invest? Remember, when we're looking at corporate finance, it has got a number of decisions, a number of questions which must be answered: investment, financing, and dividend decisions. But now we want to look at the investment decisions. Should we invest in a particular project or not? So capital budgeting process should account for the time value of money. Remember last time we looked at the time value of money. It should be captured when you are looking at your capital budgeting decisions. Fortunately or unfortunately, there are other methods which do not account for the time value of money. We shall see as we go. It should account for risk. Now, when we're talking about risk, we are looking at the possible uses of the funds. We are looking at the opportunity cost. Is it what we're accepting? Is it the best that we could we could use the funds for? We should also focus on the cash flows. I want you to take note here. When we are saying it should focus on the cash flows, we are saying it should not focus maybe on the profits, but on the cash flows, because investors are worried, are concerned of what actually flows into their pockets. It should rank competing projects appropriately. So at the end of this chapter, you must be able to rank projects appropriately. It should lead to investment decisions that maximize shareholders' wealth. Remember our first chapter where we said the goal of the firm is the maximization of the shareholders' wealth. The one who invested in the project should reap the benefits of investing. So it should lead to investment decisions that maximize shareholders' wealth. Now, we've got a number of capital budgeting decision techniques that I want you to read further on. We've got the payback period. It's, apart from saying it's most commonly used, there's the easiest one. You can calculate or look at that. You can come up with the payback period without even having gone through this chapter. The accounting rate of return, which focuses on the profits. Remember, we said a capital budgeting decision should focus on cash flows. This one focuses on the profits. Payback period does not concentrate on cash flows. It concentrates on time because it's a period. Net present value, best technique theoretically. I don't know which one is the best practically. Internal rate of return, then the profitability index. We've got other methods like the modified internal rate of return, which we shall also look at as we go. Now, we've got that example that we have there. We've got two projects. We want to see which one we can invest in, or we just want to evaluate those two projects. The first project requires an investment of $250. And in the first year, it will generate 35 net cash flows of $35. Second year, $80. Third year, $130, as shown on the table there. And then the second project has got those cash flows which are there. So we want to look at all those methods there payback period, accounting rate of return, NPV, internal rate of return, and profitability index as they relate to these projects. Now, before we compute the payback period, let's first look at what the payback period is. Now, this is the amount of time required for the firm to recover its initial investment. That's the project's payback period. So, for instance, if we look at project A, we must be able to compute or calculate the payback period of that project. Now, when we're looking at the payback period and we have such a project with cash flows as shown there, we assume that the cash flows, for instance, cash flows of $35 in year one, that they are received equally throughout the year. The $80 in year two, it was received evenly throughout the year. That's one assumption that we make when we are using the payback period. The payback period has got those advantages. It's simple, easy to understand. It focuses on cash flows, even though the answer refers to time. Disadvantages: does not account properly for time value of money, does not account properly for risk, cutoff period is arbitrary, does not lead to value maximizing decisions. And to address that, we can make use of what we call the discounted payback period. Now, let's